My name is Michael Gayed, publisher of the Lead Lag Report. Joining me for the hour is Jens Nordvig, who I had on, I think, well over a year ago. And I remember that being a very, very well-attended space, Jens. So for those who are not familiar with you, introduce yourself. What's your background? How'd you get involved in markets? And what are you doing currently?
Okay. I've been doing this for a little bit. I started my career at Goldman in London, then Goldman in New York, and I've been in New York almost 20 years. Then I did Bridgewater Associates, head of research in the Morris Securities, and then I launched my first company on my own in 2016. That's called Exante Data, where we deal with institutional investors around the world, try to help them take risk, manage risk. And then I have another company that's called Market Reader Inc., where we're building software to explain what's going on in market in real time. So trying to keep busy.
So I want to hit on what you just mentioned, which is try to help institutional investors manage risk. It seems like it's kind of challenging now, given that a lot of these kind of historical correlations aren't behaving as you would expect them to. How do you think people should think about risk in an environment where it seems like every time you get back to maybe the inverse correlation of stocks to bonds, it just doesn't want to kick back in?
Yeah, I think it's actually much easier because there are huge macro risk out there. If you can get the macro call right, it's going to make a huge impact on the portfolio. So I think it's much better time to really be focused on macro now than, for example, 2018, 2019, where, you were talking about whether GDP growth is going to be 2 or 2.2%. That was the extent of the macro debate. Now we talk about whether inflation is going to be 5 or 1. We can have that debate, right? So big macro calls to be had. And this week is a very exciting week, right? Where I think a lot of people are waking up to the reality that China is in serious trouble, right? So if you've had that call right, you'd be prepared for this week. Otherwise, you might be a bit on the back foot now.
All right. So let's get into that. And I've been warning that the conditions are there for a credit event. I myself think it probably comes more from BOJ, but everything's ultimately interconnected when it comes to global markets like this. Lay out for the audience what's going on with China this year, because the narrative at the start of the year was reopening is going to be very bullish for China, and it ended up being the exact opposite.
Yeah, so I've been doing COVID forecasting for 3 years. We started in January 2020, and we ended it in January 2023 when it was clear that China was coming out of their COVID wave, right? And then we had a couple of months where the Chinese economy was coming back from being entirely shut down. It was almost like a mechanical thing, right? That everything was super depressed because of the lockdowns, and they came out of that physical lockdown and there was some activity that bounced. And since then, and we've seen that very clearly in our indicators, we have daily activity indicators for China that we track around the clock. At the end of March, they started to peak out and things have been going south since then. And then I would say we've reached sort of a new phase over the last few weeks where not only is the reopening momentum slowing, but there's some data indicators that are starting to flash at least orange, maybe red. And at the same time, we have, financial market indicators from the real estate sector looking extremely dire, right? Like we always tend to compare with what happened in 2008. Is it worse than 2008? And it's a kind of weird benchmark, right? Because that was a full-blown meltdown in credit markets, funding markets, and so forth. And that's not going to be happening in China because China has a controlled financial system. They're not going to let the banks shut down, right? So it's not going to be like that. But if you compare what's going on in the real estate sector, we essentially have all the big players in the real estate construction industry in serious trouble, and you could argue teetering on bankruptcy, with Country Garden being the latest one to delay some bond payments, right? So it is a very, very serious situation. And then on top of that, I think last night was a kind of, maybe I should say, grotesque example, right? We have the central bank cutting rates, surprising some a little bit. And then like literally 10 minutes after, we have the state banks coming in and intervening in the currency, right? So they want to cut rates, but they don't have the currency move. So they have all these conflicting goals, and maybe they even have conflicting people that are fighting a little bit internally about what to do. And it generates not very powerful policy response. And it's pretty remarkable, right? Like if you watch the ups and downs we've had in the market over the last couple of months, we've had many, many waves of hope. You see copper prices trade up. Chinese stocks trade up for a couple of days, right? And then the hope kind of fades, right? Because actually the stimulus hope was mostly just hope, and we didn't really get anything very concrete. That's really been the story of the last 3-4 months. And we're still waiting for anything concrete. Maybe it'll come, right? We just haven't seen it yet. And now markets are starting to respond with the currency breaking out in a way that's been surprising to me.
I'm glad you mentioned Evergrande. I had joked that people forgot about it and they thought it was like a Starbucks drink. But when Evergrande happened, the narrative at the time was this is the first domino to fall in terms of an impending real estate crash in China. But your point about a controlled financial system is well taken. What makes what's going on more recently different relative to what happened with Evergrande back then?
Yeah. So I think it's very interesting, right? That we had a big real estate company, Evergrande, generating an incredible amount of attention 2 years ago now. It's 2 years ago. And I can even observe it from my Twitter feed, right? Like, I think when I wrote about Evergrande 2 years ago on my J Nordvig handle on Twitter, it's probably the single day that I got the most Twitter followers. I got 5,000 followers on that day or something like that because I wrote something borderline intelligent about Evergrande. And now we are 2 years after, and actually the bigger real estate companies, Country Garden and so forth, are the ones in trouble. And you can go and look through Wall Street Journal or Financial Times or something like that. Is that a big focus in those papers? No. Like, there's not that much focus on it, right? So we have this total meltdown in real estate, and it's actually not getting that much focus. And it is different from the global financial crisis or the US version of the financial crisis, right? Where the banks were literally shaking themselves, right? So that's not the case in China, but the real estate issue itself is, I would argue, bigger. Like, the home builders in the US survived. And in China's situation here, we have them really having liquidity issues, having a hard time actually fund their ongoing operations. So it's a very, very serious issue. But what is new now is that it looks to me like we're having a real confidence crisis on the ground, not just around real estate specifically, but if I look at the latest credit data that came out last week, we have various initiatives to try to boost credit. We've had mortgage lending rules and so forth have been relaxed. And then you look at the numbers and people don't want the credit. So that's kind of like going back to Richard Kuh's theories and so forth, who I used to work with at Nomura, right? Balance sheet recession. At some point, you get to a point where actually it doesn't matter what the interest rate is. People just don't want the credit. That's what it looked like in the very latest credit numbers for July. And that's extremely concerning. Then we had another batch of numbers last night. Retail sales barely growing, right? When a lot of people thought, okay, we have reopening, retail sales should be strong. So but those two data points combined with everything we're seeing in the financial system suggests to me that there's a potentially very serious confidence issue in the economy. I don't think it's a coincidence either that they stopped publishing their youth and unemployment statistics overnight, right? They know they have a confidence issue, right? They're trying to do kind of desperate things to avoid that confidence problem being even bigger. But that's really what looks new to me. We haven't seen that before to the same degree.
Yeah, and that removal of the reporting of youth unemployment, I think, is interesting. How connected is youth unemployment to housing or construction in China?
I think it's a broader issue, right? That we've had China's economy is slowing on a multi-year scale. And then you have certain sectors that obviously had been observing certain types of new entrants to the labor market, right? But I think it's much broader than that. The economy is just weak on a broad basis. They continue to rely on exports, which are now peaking out as well. So this is a totally different regime for the Chinese economy than they've been living through from, the early 2000s until a couple of years ago. And in a way, it's no surprise, like no economy can grow, 6-7% real for many years in a row, right? And eventually there's a reckoning. And that reckoning is now in China. And credit numbers, I think, is if you're going to pick one data point that sort of crystallizes that you can't get people to take credit, even with low rates, that's very telling of what situation we're actually in.
How much of that confidence crisis do you think is just sort of, a demoralized population after so many years of this kind of brutal lockdown. It seems like it's almost just now it's somewhat in the blood, right? The way that people are responding to in China to economic activity after just years of suffering.
Yeah, I think that there's probably a lot of that. Also, don't forget, right, that a lot of Chinese households have almost all their net worth in the form of real estate, right? Financial investments are not a big part of the portfolio. By the way, if you had any financial investments in Chinese stocks, you would have done extremely poorly, right? You've essentially had no return on a multi-decade basis. But real estate has turned, right? It's very hard to sell real estate, right? So either you have an asset that's going down, you have an asset that is illiquid, and lots of families will own more than one property. And we've had an incredible amount of overbuilding, right? And now the government has been so for more than 2 years, try to do something to revive that market, right? But with that overhang of excess capacity, that just is no easy solution. So I think as you refer to, okay, the COVID lockdown certainly had an impact on the psychology. It was very traumatic for a lot of families, right? But there's also a wealth effect and concern about the future, and the rising prices, positive sentiment around real estate was a good thing until it turned. And now it's a dramatic negative and something that makes people very worried about the future. We don't have a lot of social security in China, right? So whatever assets you had, typically in real estate, was your pension or your social security, right? So if that's in question, your future is very, very uncertain overall.
There's been talk for a while. It's kind of gone in and out around this idea that China is going to go to the way of Japan, right? Kind of the Japanification of China. Is there any way out of this broader malaise? I mean, if the natural response is, okay, so they just stimulate. Okay, but the problem is there's so much debt that it seems like you're almost at the same juncture as Japan in 1989.
Yeah. So we at Exante Data, right? My team, we try to track all the little bits and pieces of stimulus that have been announced, and we have a big table with all the steps they've taken over the last few months, right? And there's a lot of them, but they all kind of like small. And it's not obvious, even if you add them all up, that there's we've kind of reached a tipping point where it's really going to make a big difference, especially if you have this confidence crisis that is sort of beyond normal, cyclical, looks like a kind of more structural shift in confidence. So that's a real challenge. So what could they really do that will be different, right? So I think there's a debate starting in China about a different type of stimulus, a type of stimulus that would not be the one they have been pursuing for the last 2-3 decades, which has been based on infrastructure, sort of heavy industry exports. And instead it'll be based on, okay, let's stimulate the consumer. Chinese savings rates are extremely high, world record high, right? And it goes back to the point I made about lack of social security, right? There's a lot of precautionary saving, right? Because it's not sort of perceived that there's going to be any backing for you from the government when you get old and so forth. So if there was a more aggressive effort to really put money in the pocket of the consumer in the household, that could potentially make a big, big difference. I'll go back to the reopening dynamic we've seen, right? The Chinese reopening dynamic has followed a very, very different trajectory than all other major economies, like certainly the US, certainly the European economies, Australia, Canada, and so forth, and even Korea and Japan as well within Asia, in that we had a mechanical reopening. Okay, people went to the restaurant when the restaurant opened, they took the subway again, but there was not a big transfer taking place during the lockdown to stimulate the economy. And therefore, coming out of the lockdown, there was not that big boost to spending that we saw, obviously, in the US and other places. And that's part of the same story. The lack of transfers to household is also what is creating a difference now, even in the inflation numbers, right? It's well known that CPI is very low in China, even though they just come out of a reopening process, whereas any other major economy that's experienced a reopening process seems some kind of spike in prices in the, call it 6 to 12 months after reopening took place. Not so in China, right? A lot of big differences there. And I think it comes back to the lack of transfers, and it comes back to the confidence effects that are associated with that, probably combined with what you mentioned earlier, there's sort of a trauma from the lockdowns having been extremely severe as well.
Yeah, that's right. When you say lack of transfers, my mind immediately goes to CBDCs as sort of the response and the answer to that.
Yeah, so obviously China is building technology to do very targeted transfers to central bank digital currency. There are test pilot things going on that means that they have the technology in place. So certain people have the wallets and so forth. It's not something that's been used at a country level macro scale yet.
What's the risk of, as much as China can maybe manage the downside or at least the speed of it, what's the risk to global markets? I know that sounds like an obvious question, but I always go back to it's about path, not prediction. So, if I am right, and I could be very wrong on this idea that the conditions favor some kind of credit event, spread blowout, which is what you typically see in recessions and bear markets anyway. Do you think it could be from China that starts that, or is it still too controlled to be sort of a global systemic risk?
Yes, I don't think it's going to work through the banks in the way we've typically seen in many other crises. So I think it's going to work through the real economy. And we've certainly seen, right, that Asia is different from the rest of the world, right? Lots of Asian economies, not Japan, but like other South Asian economies have a different monetary policy situation than we have in the US. Like, we're not talking about aggressive hikes in many Asian economies, and inflation was never a big of a problem in those economies. So I think the way it would migrate through the system is that we have this lack of consumption, weak demand, and it migrates to neighboring economies, Korea, Taiwan, and so forth. Could have an impact on commodity markets as well. So I think it goes through a more real channel than we would typically see in the US or in Europe, where it typically goes through, the banks are in serious trouble, right? And it goes through the markets through that channel. So from that perspective, I think it's slower, but that doesn't mean it's not going to be a problem over time. And you can see, like, we've been talking about this as we just mentioned, like Evergrande was 2 years ago, right? So this is something that's going to be at least a 2-year process. If you think about like the US situation, like we had severe tension in the US housing market, like for a period of time, right? But markets actually bounced pretty aggressively from, call it March 2009, right? So the real severe part of the tension in markets was concentrated over a 6 to 9 month period, right? Whereas here, because the banks are not allowed to fail, it gets drawn out, but it doesn't mean that the pain is smaller because it just gets drawn out over a longer time frame.
Talk about how currency movement factors into all this, not just relative to the dollar, but I'm thinking more relative to the yen, which I keep going back to. I think is going to be a real problem for Asia in general.
So let me start this way, right? So similar to the banks being controlled by the Chinese government, the currency is very controlled by the Chinese government. Historically, it's been tightly managed, right? And we've had a lot of focus over the years on what is China doing with its currency reserves. Are they buying treasuries? Are they doing other things with them? How are they going to spend them now? But I think China is operating a bit differently after 2017. In the mini balance of payments crisis, 2015 to 2016, when we had quick currency weakness, China used its currency reserves aggressively to try to stabilize the currency. But I think they were very surprised how expensive it was. So they essentially spent $1 trillion intervening in the currency market over that period of time. And it had some impact, but they came into that crisis in round numbers with 4 trillion reserves, and they came out with 3 trillion, right? So I think they're looking at the situation now. The economy is bigger. Global markets are even bigger. Like maybe it cost $1.5 trillion or 2 trillion to have an impact on this occasion, right? And then do they be close to a sort of lower bound for what is a reasonable amount of reserves to have for a big economy like theirs? So I think they're quite reluctant to spend reserves to defend the currency. So the pattern that we're observing now is that they're trying to send signals to the market. They have these daily fixings every night, 9:15 New York time, they come out with a fixing trying to guide the market, right? But it's a bit of a kind of trust me, trust me, we want the currency to be stronger, but we don't really want to back it up with hard currency like we did in the old days. So last night they told the state banks to come in and sell some dollars, and the state banks probably have a couple $100 billion in capacity to do that. Brad Setzer has done good estimates of that. We were tweeting together this morning just to compare notes. And so they have some ammunition there, but a couple $100 billion, it's not really that much. So I think it's going to be just used for smoothing purposes, right? So when they think the currency is moving too fast, when they think it's negative for overall market sentiment, they're going to try to slow down the move, spend a couple billion here and there, slow the move. But it's not something that's a line in the sand. It's not something that changes the direction of the currency. You could see it in the price action very clearly last night. Like they intervened at 728, right? And then we dipped a little bit below, and then we ended the session higher. And now the offshore market is way higher. So it's not something that changes the trend. It just creates a little bit intraday volatility. Actually, it's creating some nice intraday trading opportunities if you're into that kind of stuff. But it's not going to change the direction overall. And I think also there's a debate that is related to that now about, is China going to defend the currency in a way where they'll have to sell a lot of treasuries? I think that was the case in 2015, 2016. But I think they don't want to do a big amount this time. They've decided that they're going to try to keep the currency as smooth and stable as they can without spending a lot of reserves, which is not an easy thing to do, but that's what they're trying to do. And therefore, I don't think we're going to have enormous treasury sales coming out of China for this reason. There's going to be some, but the amounts are not going to be that big in the scheme of things. So I don't think it's a dominant force. And Michael, I think you're asking about Japan as well. Just remind me what angle you want to do on Japan.
We want the yen move.
I think there was a period of time when, not that long ago, but it seems like a long time ago, where we were focused on different monetary signals in Japan, right? Lifting the yield curve limit on the JGBs from 0.5% to something higher, right? And when there was that focus, there was some impact on the Chinese currency as well, because they kind of trade together, right? But now we've kind of learned that, okay, JGBs are actually moving only a tiny bit compared to what's going on globally, right? So rate differentials are not moving in a yen supported directions. Like if you look at rate differentials, it's just like, it's obviously like a very naive to say, okay, you can trade currencies based on one variable, but it's an important variable, right? And it's pretty remarkable, right? We have 2-year rates just drifting significantly lower in China, while US rates are going up in a very dramatic way, right? So rate differentials have moved out in a very, very pronounced way, quickly from 150 basis points to 300 basis points. So it's a very dramatic thing. It's a historical thing. And then obviously there's the focus on, okay, what is happening in Japan with the long end of the yield curve. It's an interesting thing when you have, like, it's a bit ironic what's going on in Japan in the sense that we have a historical shift in motion, right? We've had a long, long period of quantitative easing in Japan. Some would argue that Japan invented quantitative easing in the early 2000s, right? And they've been buying bonds since then. And now they're exiting. The first tweak to the yield curve control was in December. The second tweak was a couple of weeks ago. And nevertheless, even though it seems like, it's a dramatic thing, they're starting to do it, really the big surprise, I think, has been how orderly it's been, right? If you look at what's happening in the last couple of weeks, they lifted that ceiling on JGBs, and JGBs are up from slightly below 50 basis point ceilings and now call it 60 basis points. It's moved 10 basis points, and they didn't even have to, the smoothing operations they do, they did 2 of them so far, but that's like 2 weeks ago since they did the last one. So it's actually a market-based equilibrium that is so orderly. But I think it has to do with the fact that when you're taking so many bonds out of the market over years and years and years, and you own such a big part of the market, like what's actually left in the market, combined with people pre-positioning and trying to be short if they can, means that actually yields end up adjusting pretty slowly. So I think this adjustment in the JGBs, because the market has been so distorted by incredible amounts of buying, is actually going to take longer. And that means that the impact on global markets is also going to be a drawn out process as opposed to, one shock that comes in one day and we all cry about it. It's going to be a little bit low, like many months, maybe many quarters before that adjustment fully plays out.
To reset the room here, everybody, please make sure you follow Jens here on X. If any of you want to come up and ask questions, click that bottom left mic request button. And as always, this will be a podcast under Lead Lag Live on all of your favorite platforms. By the way, no disagreements on anything you said. My focus has been on just the potential of sort of, I call it a global margin call, which I think would happen if you have any kind of reversal of the carry trade, which remains to be seen. How does oil's price movement factor into risks for Japan, but also China more broadly? I mean, Japan obviously has different dynamics, has to import pretty much all of its oil. But play it out. Let's do some fair analysis. Oil spikes or oil collapses. What happens to Japan and China?
Yeah, so from basic, trade balance perspective, like Japan is very sensitive to oil prices. Korea is extremely sensitive to oil prices. And China is also very sensitive to oil prices. Although they tend to do a good job of accumulating a lot of inventory when the prices are low. As we've seen earlier this year, I think they accumulated quite a bit to create some buffers for themselves. And we've seen a bounce, right? So the sort of deflationary effect from low oil prices on global CPIs is reversing a little bit. But so far the move it's not an enormous move. Like it might look big in a 2-month return space or 3-month return space, but it's because we did go to very low levels, right? So from a long-term chart, we bounced from the bottom, but we haven't really gotten to levels where it's particularly concerning. I would also say, right, in Japan's case, they are restarting some nuclear power. So that's going to offset some of the import costs that they would otherwise have. So maybe the impact there is not going to be quite substantial. So like when I look at what's going on with inflation, right, we clearly have to pay attention to what's going on with commodities, right? And we had a bounce in crude oil. We have some volatility in natural gas prices now, partly because of some strikes in Australia. At the same time, metals are kind of look like they're turning lower, right? And metals are very closely linked to the Chinese cycle. As I mentioned, every time there's stimulus hope in China, copper bounces a little bit, and now copper has retraced. So I think that's something that's relevant to the inflation picture overall. So I have to say, if I sort of look at what's going on globally from a very big picture perspective, right? What is remarkable about these yield spikes that we've had is that in terms of the macro news we're getting, right? We've had lower CPI numbers, 2 months, pretty convincingly so on the core readings in the US. I like to do always a global scanning of everything that's going on, try to absorb as much data as I can. If I look at global core inflation, right, we've reset them really notably lower over the last few months. Maybe I'll send a tweet around just to showing the data that I'm looking at. So there's something positive going on there. And I think commodities, oil prices are a bit higher, but the overall commodity space in year-to-year terms still doesn't look problematic to me. So what really stands out as being very interesting and something that not a lot of people would have thought is that, we've had this breakout in yields in the US and Europe, despite the inflation news being better. So I think that tells you that there's something on the flow front that's different. Japan is a part of it. And it's something we have to respect, but we also have to weigh, okay, those flow forces that are pushing yields higher now, they're going to continue to dominate something on inflation that looks like it's better. So I think that's one of the most important questions right now. So certainly when you have a situation like the one we are seeing where the macro picture is deteriorating fast, and essentially the typical policy levers perhaps look kind of impotent compared to what would normally be the case, then you can worry that they're going to resort to other types of action, right? It is well known around the world that dictatorships typically sustain themselves by creating an external conflict, right? So certainly the military conflict. I think if the situation in China domestically is very bad, like all else equal, the probability of military conflict goes up. I'm not saying it's high, but it will be going up for that reason. So that's something to worry about. In terms of the economics itself, like I think about it as a slow motion crisis in the sense that the state banks will not be allowed to fail. And therefore, the sort of typical, you know, what should we call it, catastrophic market collapse that comes out of bank failures, as we experience in the US, even with small banks in March, right? It's not going to go through that channel. It's going to go through, death by a thousand cuts, shadow banking, real estate, all those types of things. And I think the spillover to global markets will happen through the real channel. So it is a bit different, but I'm worried that because you're not seeing like the bank headline, you don't see ICBC down, 15% in a day. Because you're not seeing that, there's a lot of people who kind of fall asleep a little bit. And that's kind of what makes this interesting. It's such a big part of the global economy. It's such an important part of the global economy, right? And now it seems like for one reason or another, there's a little bit less focus on it than there used to be. So that's quite interesting from a risk management perspective. Yeah. Well, so if we can be a little bit nerdy, right? So I think if you think about the balance of payments in China, it's something I spent a ridiculous amount of time studying over the years, right? And when they had the last problem, they essentially tried to close all the holes in the balance of payments, right? So all the different sources of leakage, they tried to put controls in place, stop them. Like just very simple example, right? In 2015, 16, there was a big wave of outbound foreign direct investment. Companies wanted to buy hotels, insurance companies, and so forth around the world as a kind of corporate capital flight, and they shut that down. But we're coming into this balance of payments problem, crisis that's going on now here in 2023, and they already closed the obvious holes. So we have weakness in the currency after they tried to close all the holes. That's very interesting. So I've been very focused on a lot of the flows that are coming in or not coming in that they cannot control, right? The foreign direct investment used to be, $75 billion per quarter, 300 billion annualized. The last number was 5. So a big shift there. And that is something that they cannot control. They cannot force multinational companies to invest, right? So the weakness in the balance of payments is coming from forces they have a very hard time controlling. And I think that is what makes me pretty confident that there's asymmetry around this currency, right? Asymmetry to the downside. And the policy tools they have available to themselves are not that powerful. They don't want to intervene. They can't raise rates. Like, what are they going to do? It's not so easy to control the currency of this size. So they can try it, but doesn't mean they're going to get it where they want. And I think there's a little bit too much respect about the PBOC can always get it where they want. Historically, that's been true. But I think they played so many of their cards already that it's becoming less and less true. So that's something to keep in mind. I just tweeted out that the global core inflation chart that I referenced, right? It's turning globally, right? So it's very interesting. We have that breakout in global bond yields with this pattern globally. So it really shows the flows are in play. We have a company called Exante Data, right, where we track capital flows in intense detail, right? So the reason we do that is that everybody have the payroll release on their Bloomberg screen, other places, right? But a lot of people are not that familiar with what's actually going on with the capital flows. So I think capital flows overall is really important. And then I would say, like the other technology we've developed is the market reader technology, right? Where that is a robot piece of software, an engine that scans all markets simultaneously and detects, okay, here's the epicenter of something that is worth paying attention to, being at, Silicon Valley Bank cracking, and then instantly explaining what's going on. So I think having a very global focus, being able to pay attention to a lot of assets at the same time is something that's helped me through my career. So I would encourage people to have a broad focus as opposed to a narrow focus. Otherwise, you'll like, world is so interconnected and complex that you're going to miss things if you don't have a very broad focus.
I wonder, again, going back to that point about, inflation is falling globally, the yields are breaking out. I wonder if there's something maybe a little bit scarier to that, not to be overly dramatic, but sort of the idea that the bond vigilantes are out there, if you want to call them that, when it comes to sovereign liabilities, sort of the public sector crisis, which you saw a glimpse of with gilts, right? And is there something to the idea that just we're at this kind of bigger dynamic, bigger phase that the bond market maybe is worrying about?
Yeah. I think it makes a lot of sense that we have a lot of focus on bond supply, right? Because we're so late in this big credit cycle where we got away with issuing an incredible amount of debt because interest rates were zero. It didn't really matter how much debt you had. Your debt service was still very manageable. So this is all different now, where we have some inflation, irrespective of whether it's come down a little bit in the last couple of months. And I think it's also going to be fascinating in currency markets over the next couple of years. It's not going to change from one day to the other how markets trade this. But we're entering into a new regime where we're going to figure out which countries have hard currencies and what countries have soft currencies. And what I mean by that is that as the governments roll their debt into higher yielding debt, so being it the US government, UK government, others, takes time to roll the debt, right? But eventually it'll be rolled. Then they face a much higher interest rate burden, and it's going to have all kinds of implications for how fiscal dynamics will play out, what kind of discretionary spending is possible. And then the monetary authorities, they have varying degrees of independence, varying degrees of political influence. They will have to decide, okay, what is our priority? Do we stick to sort of mathematical inflation target, or do we also pay attention to whether, our fiscal brothers and sisters, policymakers are in trouble? And I think you'll definitely see countries where the monetary authorities have a hard time really being solely focused on inflation. And therefore, there's going to be countries that end up having lower real interest rates as a consequence. And those, which I would see, that's the definition of a soft currency, those currencies should then be on a depreciating path. And what's interesting right now is that there's actually some countries like Sweden, Norway are examples, right, where they don't have a lot of debt. Like this problem I just outlined is not a big deal for them, but they've actually had very weak currencies recently over the last couple of years, partly because the monetary policymakers have just been very slow to respond to the inflation pressures, but they actually could respond and be conservative if they wanted to without running into that fiscal constraint that others might have. So I think at some point, if you're going to make investments, it's going to become very important whether you make investments in a country where they can support a hard currency. Like it used to be the Bundesbank that had that reputation. Now it's probably the Swiss that have that reputation, right? But it's almost like you want to scan around the world and figure out who is who. And it's going to potentially make a big difference to the returns. So
like I said, when you say hard currency, my mind also goes to gold, and you can argue Bitcoin. Is there anything to the idea that, from like an investment portfolio construction perspective, those become more important as, in quotes, hedges? Or, is it going to be exactly what you just said, with more just going to different countries in terms of the hard currency dynamic?
Yeah, I think they're going to feature in that kind of analysis, right? So we haven't really gotten to that point yet. Like you can argue in March when the regional banks were under severe pressure that, okay, Bitcoin was viewed as, okay, this is the alternative to a traditional banking system and so forth. And we had a bit of support, not that pronounced. And then there's the issue of, okay, when a central bank's going to be forced to, compromise on the inflation target, because there's a fiscal dimension that is equally important, more important. We haven't really gotten to there yet. Like the Fed been pretty aggressive, right? Like we're above 5% interest rates. If you went back and asked people, okay, what's the highest Fed rates are going to get to in this cycle, they would have said 2 or 3, and we're now above 5, right? So Fed has done a fair bit. The same thing in Europe. Like what people, you asked a couple of years ago, what's the highest the ECB are going to get rates? So they would have said 1.5, 2, right? And now we're going to 4 above. So they've been pretty conservative, and that's been the situation we've been witnessing over the last 12 months. They were behind, they're getting ahead, inflation expectations are under control. But the real test will be when the debt has been rolled, it goes into the fiscal accounts, the debt service payments are high. Can they then stick to it, or are they going to start compromising? And that's when the gold trade could be very interesting, and perhaps the crypto trades too.
Yeah, no, I think that's well articulated. I wonder if you think that we're maybe in a cycle of weird way of saying it, but a cycle of downgrades across the globe. I mean, you're obviously starting to see it with Moody's and the Fitch warning today, but I'm going to make the assumption that we're going to see more of these types of downgrades, not just in the U.S.
Yeah, so maybe I am. Maybe I was answering too quickly in the sense that you already have economies around the world, right, where there's no trust at all in the currency, right? So Argentina just had another implosion of their currency this week. The Russian ruble has been going down, 20, 30% last couple of months. Obviously, they have some, let's call it special issues going on, like African currencies, Turkish lira, and so forth. Very severe currency problems, right? So really what we want to think about is that those type of problems going to migrate to the big currencies. That's what we're talking about. And I think next year will be the test for that.
So bring it down to the portfolio and exactly what you said at the start of the conversation around managing risk. So not financial advice, but if you're looking at all the different scenarios and all the different types of tail risks, whether they're slow or fast, what makes the most sense to do? Is it one of the things where you'd say, what, more cash, maybe just lower your beta in an equity portfolio? What actions do you think make the most sense for what could be to come?
Well, if you're able to pick the places where they have hard currencies, and you can pick the point when you reach the turning point in the hiking cycle, then clearly there's going to be some bond trades that are going to be very, very attractive bond trades. I can see it. I speak to institutional investors around the world all the time, right? I'm based in New York. I was in London last week, had some good conversation with big real money players in addition to hedge funds, right? But the real money players are the ones that are interesting in that they have big, structural holdings in fixed income. And I remember we did some cocktails almost exactly a year ago in New York. It was like we were just ready to be outside on a roof in New York, and we had a lot of real money participants a year ago. And when we kind of asked them, what do you have in the portfolio? The answer was pretty much T-bills, right? That was a year ago. And then in terms of, this is kind of just an anecdote, so I'm not saying go and invest based on anecdote, right? But we can see the same in our data. We can see that when we track, the duration exposure of U.S. bond funds, and we track that every month with all the information we can get our hands on, right? That they have taken a lot more duration exposure. As they're getting ready to do that trade, they may have been too early in the trade, but it is their business, global bond funds, to get into the bonds at the right time and ride those appreciation trends when they happen. And that's what they're all looking to do. And obviously, if you can find the right timing and obviously don't have to do it without a currency hedge, but if you want to take the currency exposure, then obviously you want to pick one where it's a conservative central bank that's going to really get inflation down. That way you get the juice both on the currency return and the normal bond yields actually being able to go lower and give you more capital appreciation over time from that source too, if you get the right entry point.
Yeah, and for those who want to track more of your work, I know you mentioned Market Reader a bit, but maybe just talk about some of the things that are kind of in the pipeline as far as that goes and how people can track some of the analysis you put out.
So we have two companies that because it's been pretty expensive to build a Market Reader technology, so we had to fund it in a separate company. So it's called Market Reader Inc. So there's a separate Twitter handle for that. Definitely encourage you to follow that. So Market Reader Inc. is the handle, but if you just type in Market Reader, it should pop up. I can tweet it out now as well. There's any doubt. So that company is really meant to help everybody. So in my career, I had a lot of focus on, helping macro hedge funds, helping, CIOs from big investment managers. But the Market Reader technology really is built for everybody in the sense that it tells you what's moving in the market. It knows what is a normal move for each asset, right? So it's not going to give you NVIDIA or Tesla every day. Like it's in a volatility adjusted space, it shows you the interesting moves, right? And then it explains why they're happening in real time. And it gives you a fantastic way to just absorb what's going on based on how the market is reading what's going on and position you to make active decisions in a timely way. So I've definitely encouraged everybody to follow that handle, Market Reader Inc. on Twitter. And we are starting to allow our first users on the platform. We're still trying to figure out like how we handle institutional users and that people who are private. I don't know what the right term for it. Some people call it retail, but that is not always accurate. There's some private investors that are very, very capable and extremely informed, right? So we want to help all those. So it could really be a piece of software that could help a lot of people. And I would certainly say, like, when Silicon Valley Bank cracked that Wednesday night back in March, it was pretty handy to get an alert. Okay, here's something that you need to pay attention to. And it took really the market, almost 24 hours before it had digested that news, right? And having that type of lead is something that could be extremely valuable from a risk management perspective. So that's one use case. There's a lot of also all the use cases. If we essentially are able to understand the price action in the market and attach an explanation to it, this is something that can generate really the next generation of financial news and insight, in the sense that if you have parsed everything that's going on in the market in that way, you will have a content stream that you can do other things with. You can say, okay, tell me what has happened in semiconductors in the last 2 weeks. And you can actually extract all the insights that we have generated over that time period, instead of just having, a very, very noisy news feed that you have to manually scan through. So this product will have different phases attached to it. And at some point, we will have like a much more flexible way of summarizing across the assets that you are interested in. We already have watch lists in the system, right? But at some point, we will also be agnostic about the time horizon. So if you're somebody who like to look at the market every Saturday morning and understand what happened in the previous week, that's one use case. If you're somebody who really just want to have an overview of what happened in your portfolio at the end of the month, at the end of the quarter, we can really extract an incredible amount of information from the market and summarize it with very little noise. So it gives us some different opportunities to essentially create totally new products. So that's something we're very excited about. It's sort of be nice to have a product that has no competition. So that's in a way the goal with this.
Everybody, please make sure you check that out and make sure you follow Jens as mentioned. I will again have this as a podcast under Lead Lag Live, and appreciate everybody joining. Thank you, Jens. Appreciate it.
Okay, thank you.